Hello, everyone. How are you? Can you hear me?
Yes, okay.
Okay,
It's
great.
okay.
Thank you for including me in today's conference. Do you have the ability to show slides, the ones that I sent?
Yes, just a moment.
Okay, thank you. So I'm unable to make the connection to the last discussion because my Portuguese is non-existent, and I apologize that I have to speak in English. Thank you for including me, and thank you to Wilson for extending the invitation. My intention today is to discuss financial transaction taxes, in particular in the United States. And I designed a proposal with a co-author, Laura Kawano, 2 years ago. And it was as part of a project at the Brookings Institute, the Hamilton project of the Brookings Institute, which was examining ways to raise revenue for the United States. The United States has very little revenue relative to its needs. And I was asked to look at the financial transaction tax, given my background in financial markets and at the Treasury Department. And I came up with a proposal which had some acceptance, and I'm going to go through it with you today. And I'll move relatively quickly because my topic is more narrow than the one you were just discussing. And then perhaps there will be time for some discussion. So if we go to the next slide. So what we did was we published this during the presidential campaign when the Biden was running, but so too were various other candidates. And we wanted to insert the idea that an FTT, a financial transaction tax, should be part of the dialogue in the United States. And we found that the advocates of a financial transaction tax, as well as the opponents, were making arguments that did not hold up. And so we sought to test their arguments and to design something which we thought was viable in the context of US financial markets. And that's what we produced. So if you go to the next slide, we concluded that an FTT in the United States could raise $500 billion over a 10-year time period, which was around 1.5% of the federal revenue. So 500 divided by 50, 1.5%, that it would affect mostly high-income taxpayers. And importantly, we found that it would not have any real effect on the ability of financial markets to assist in price discovery. I mean, one of the complaints about a financial transaction tax is that it will harm the ability of markets to function and the ability of prices to be set. And we found that a tax of the sort that we designed would not pose that kind of problem. So a bit of background on all of that follows. The FTT first gained, as you probably know, popularity following the global financial crisis in 2008. And there was a bit of an error in marketing, which is to say an FTT was initially said to be a Robin Hood tax, namely it would take only from the rich and give only to the poor. And as we found, that's not the case. It has a bigger impact on the rich, but it does affect everyone. The second claim about a financial transaction tax at the time was that it could raise many times the estimate that we had, trillions of dollars. And we found that that was impossible for reasons I'll mention. A third claim about financial transaction taxes was that it would reduce the financial market risk, that it would reduce speculation, that it would reduce volatility. And our research did not show that. There was a case to be made, there is a case to be made that it could reduce the weight of financialization in the economy, but that's a slightly different argument than the ones which were being made. And then last, there was an argument that it would make shareholders and investors focus on the long term. And we found that there was little evidence for that as well. But we found also that these arguments are not necessary for an FTT to have merit. And so we pursued it. And if you go to the next slide, we thought about how big, the first question is how big can it be? And so I have a couple of slides here about how we came up with the size of our proposal. And if you think about a financial transaction tax, I mean, well, it's very simply a tax on an activity. In this case, the trading of a stock or the trading of a bond. And when we look at the cost of trading in the United States, which is obviously the most liquid market in the world, the cost of trading a stock, direct and indirect, is a fraction of a percentage point. These are in basis points. So each basis point is 1/100th of a percentage point. And equities are around 15 to 35, 0.15% to 0.35, bonds slightly more, municipal securities that fund states and cities slightly higher. But our view was that if the financial transaction tax is low relative to these levels, that it would have very little effect on price discovery, on liquidity, or on financial markets. And indeed, if you look at equities, if you can see it, the dark green shows that in the United States, commission costs, what you pay the broker, have gone down progressively, and they're now basically zero. But there's an indirect cost, which is implementation shortfall. And that's the change in price as a result of your desire to trade. And that change in price, which has always been there, because others will see your desire to sell or your desire to buy, has remained elevated. And so an average order will result in about 1/3 of a percentage point of cost. So our view was that 10 basis points, which is less than 1/3 of that total, would be manageable by markets. On the other hand, if you look at this, it's very clear that if you raise that by 5, so for example, to 50 basis points, which is the proposal that some have made in the United States, it would overwhelm the costs and would necessarily lead to reduced liquidity, impeded price discovery, and arguably a loss of value of holdings. So we felt that 10 was the maximum that markets could support. If you go to the next slide. So our proposal very simply was that we should have 10 basis points on almost all stock, bond, and derivative transactions, that this should be gradually introduced over a period of 4 years, starting with 2 basis points, and then scaling up gradually to 10 in year 4. And that every year there should be a review, and I think this is relevant for many markets, of tax avoidance techniques that traders will inevitably design and the impact on market functioning, so that the basic rules could be improved and tightened and calibrated. And we accepted from this US government borrowing and money market. The critical thing, which is the 4th point here, is that this needs to be pursued internationally. The worst examples of financial transaction taxes, for example, in Sweden, have seen flight of trading away from the main market that has the tax. And even for the United States, which accounts for 40% of all trading in securities, our belief is that it needs to be pursued internationally. And then there's the question of onshore versus offshore, and we applied it to all trading in US securities. Next page. So the costs of all of this, how to think about it. The direct cost to the investor, the end investor who holds for a long period of time, is really very small. It's not something that anyone would notice. A frequent trader will in fact see an effect of this. And so it's a discouragement of frequent trading. And it will result in a reduction of trading. There is a supply demand, there's a supply demand curve that gets affected by this. And the costs would be lower in our analysis than the other investment related costs like management fees and the like. And so again, our conclusion was that this could be done in the United States. This could be put in place. If you go to the next slide, and then who pays it? Well, who pays it? It's basically the highest income families will pay it. 70%, according to the incidence analysis that we carried out with the Tax Policy Center, 70% would fall on the highest income by quintile. And the cost for the lowest quintiles of income, very low, $10 for the lowest income, $60 for the second lowest, $160 for the middle. And of course, if you look at it according to wealth as opposed to income, it's even more concentrated. And we would subject foreign investors, non-US investors, to the same FTT. So we found that it was doable relative to costs and that it was progressive when measured against incomes. Next slide, please. Now, there is a massive mobilization in the United States, as all around the world, from opponents to a financial transaction tax. And these mainly come from, and I'm going to list them in order, high-frequency traders who trade by computer and match buyers and sellers by computer, whose business models would in fact be very threatened by this tax. Another opponent are active institutional investors, and in general, intermediaries of all type. And they've been very effective in scaring policymakers in the United States from implementing a financial transaction tax. And that's because these intermediaries would not pay the tax, but they would have reduced profits. And so a reduction in profit is a very strong incentive to try to keep a tax from passing. And the arithmetic that they use, we highlight some of the flaws here in the arithmetic, but even a firm like Fidelity or Vanguard, who is transparent in their calculations, nonetheless use these techniques, which are scare techniques. And the tax got labeled as a tax on savers or a tax on retirement. And in fact, we were able to show that their calculations didn't take into account any assumption about elasticity, in other words, reduced trading because of the tax. They all used the transaction tax that was too high, and they didn't pay attention to the fact that the tax would fall on wealthier households. And lastly, we do believe there's a behavioral effect that pensions, for example, very often are invested in high cost, high turnover trading strategies. Our belief was pensions would move towards lower cost, passive strategies. And so the behavioral effect would actually be good for pension returns. If you go to the next slide, and then I hope we have time for some discussion. There are some international examples, as you know, and an interesting one is Hong Kong. Hong Kong has a very effective financial transaction tax, which is actually higher than the one that we proposed for the United States. It's double roughly. And it raises around the same amount of money as we thought. It raises 1.2% of gross domestic product. And it's had very little effect on the liquidity of Hong Kong markets or the success of Hong Kong companies or offerings, but it has raised real money for the government. On the other hand, there are some notable failures. Sweden had a very big financial transaction tax, which killed all trading in the Swedish stock exchange and pushed all trading in Swedish stocks to other markets. And so it was a failure, but there are reasons it was a failure. And France and Italy also have had trouble because there's been no cooperation in the European Union. However, neither of those are examples of why an FTT shouldn't be pursued. They're both examples of an FTT with a poor design. So design is everything. And our focus was to gradually introduce it, to leave room for calibration, and to not overshoot in the efforts to raise revenue. If you go to the next. And so it was our conclusion that an FTT in the United States could raise very high amounts of revenue over a period of 10 years, that it would affect the households who could most afford it for 70% of the burden, and that markets would function perfectly well, and there would be adequate price discovery with a financial transaction tax. So that was 2 years ago. Two of the presidential candidates, including Biden, adopted an FTT. Michael Bloomberg adopted the FTT that we designed, and there's been draft legislation from the Senate to introduce the FTT as proposed here, but it's gone nowhere. And the complexity of the topic, together with the very well-funded opposition, have meant that it's no longer part of the discussion. I believe it should be part of the discussion of a way to raise revenue. And I also believe that it would have a beneficial effect in behavior, which is to say, if you tax a behavior, you end up with a bit less of that behavior. And trading in the United States has absolutely exploded over the last 20 years. And the United States could do with a bit less trading, frankly. It has had no beneficial effect on price discovery, on the efficiency of markets. It has merely served to introduce more intermediaries and more volumes of trading. There's some suggestion that this has in fact harmed savers, and it has certainly resulted in an increased amount of resources devoted to financial activity in the economy, with little real benefit to the economy. And so it has some of the benefits of, for example, a carbon tax, which is designed to reduce carbon, and it can be done in a safe and a sound way. So that was the proposal. There's a more detailed paper available for those who would like to go into the details of this, but perhaps I'll leave it there for the moment. And if we have time to discuss later, I'd be happy to take questions.